Hello, everyone. It's chapter 3, and we are going to get into the nitty gritty of financial statements. What do they communicate? How are they set up? All right, so we want to really understand uh, how, what goes on each financial statement, what they should look like. There is no absolute way to say that this is how every financial statement will look. You have to, we're going to look at some general ideas because each company has different something to communicate, and there's enough flexibility in accounting to let each company kind of customize what they feel like they need to while following the general rules. So, jumping in first, and we're going to do this in an order that I want you to remember. This is the order that if you were an accountant, you would be producing these financial statements or working on them. So the first one is income statement, also called the statement of operations. That tends to be the new, more jazzier term, you might say, for it, but either one will work. Starts with revenue, what they have earned. That's always first. Revenue, sales, that's the first item on the income statement. Then we subtract the cost of goods sold, the cost of what we are selling. If it is services that doesn't have stuff, then that may say cost of services, which would be the people you're paying to provide the services. But you subtract that direct cost, and get gross profit. This is a multi-step income statement, which is our preference because you have this subtotal gross profit. If you just go on to the expenses and you don't have subtotals, that's referred to as a single step income statement. And in my opinion, it's not as useful. However, there's nothing that says you have to do that. It's not prescribed one way or the other, so companies can choose. Then, so cost of goods sold is an expense. It doesn't say expense in the title, but it is an expense. It may be a special kind of expense. It's probably the largest expense. It's maybe the most important expense, but it's still an expense. Then we would subtract out the other expenses that are not cost of goods sold. We might, if there are gains or losses, we would add the gains, subtract the losses. They want to come after the other expenses as a way of indicating that they are less important, you might say, to the future of the company because they are not part of the normal, ordinary course of business. And then tax expense, which we're not going to spend a lot of time talking about in this initial class, more so later. It's important, but we tend to blame it on the government, not on the company. And so because of that, because it's kind of different than other expenses, it tends to be the last one reported on the income statement. And then after you've subtracted all those expenses or added whatever, the gains, you get net income or net earnings. So roughly, the simplified version is revenue minus expenses equals net income. As you can see, it's a little more complicated here. This income statement is always for an accounting period. It has to have a start and an end. And we measure all the activities or operations in between those two dates. So it has to have a start and an end. So if we're doing an income statement for 2019, it would start on January 1st and end on December 31st, 2019. However, many companies use a fiscal year. So they might start on May 1st, 2020 and go to May or April 30th, 2021. That would be a fiscal year. It's still a year. It still has a beginning and ending. All right? So, and we can measure a shorter period of time, like a quarter or a month. That's very common as well. But it must have a start and end date. if it fits the definition, if it is a revenue, so we see something recorded, we see it tracked, we track it in a, the increases and decreases in that. If it fits the definition, and we learned about the definitions earlier, then it belongs on the income statement. That's how we know if it goes there. Everything has one place, except for two or three things that go in go in two places, but for the most part, they have one place. And revenues, expenses only go one place, and that's the income statement. So a little bit turn to the idea of revenues and expenses from a primary business operations. Gains and losses are not from primary business operations. So if Home Depot is selling hammers and saws, that's inventory, that's revenue. If they sell off some of their shelving because they buy some new stuff, that is going to be recorded as a gain or a loss, because that's not what they're in business to do, is sell off their shelving in their stores. Now, some shelving, the shelving for you to take home, but the shelves that they usually use to display their stuff, if they get rid of that, that would be a gain or loss. When we record revenues and expenses, we keep them separate. We record the revenues, like the sale of $100 of stuff, and we record the cost of goods sold for what we paid for it. When you have a gain or a loss, you simply record the difference between what you paid for it and what you sell it for as the gain or loss. So it's just one amount instead of two. So there's two differences between revenues and expenses and gains and losses. Revenues make net income go up, gains make net income go up. Expenses make net income go down because they're subtracted. Losses make net income go down because they're subtracted. Okay, tax expense, like we talked about, is usually determined by the government, not the business, which is why we don't spend a lot of time calculating it or talking about it, and it's at the bottom. Okay, usually we will see on an income statement more than 1 year to show trends. Net income is often the number that gets the most attention on the income statement. It tends to be the kind of measure of whether they're financially healthy. High net income is good, net loss is bad, net income is going down is not so good, that sort of thing. Going to an example of an income statement. This is Home Depot. Just like we said, starts out with sales or revenues. Then we subtract out cost of goods sold. In this case, they refer to as cost of sales equals gross profit. Here's our other expenses. And then there's a loss. And we have other income and expenses, taxes, the last expense, and net earnings or net income. We have 3 years displayed. You can see that sales are up substantially fiscal 2018, a little bit in 2019. You can see that net earnings is almost identical from 18 to 19 fiscal. Big change between 17 and 18. Notice that the tax law changed and the amount of taxes they paid went down substantially for the last 2 years. Had nothing to do, again, with Home Depot, all to do with the change in the tax law. Okay, a couple of things that might give you some issues, things you might have to think twice about when you're doing these financial statements. Is it an asset or is it an expense? And the key thing here is whether or not it provides future or past benefit. Future benefit is an asset. Past benefit is an expense. if you used it in the past and you don't have it, it's not going to provide any benefit going forward, like your utilities, like an employee's wages, that is an expense. If it is a building or equipment or things that are going to provide future benefit, then it can be an asset. What is in the future right now is going to be present tomorrow and eventually the past, right? So we utilize up assets, many cases, and they become expenses. That's an important concept. They become expenses because the benefit, which was in the future, is now in the present or the past. Okay? Conservatism, we talked a little bit about this in our discussion of accounting principles. It's the concept that we don't want to look too good. We want to never surprise people on the negative side. So we kind of take a view that if there are two situations, there's an equal chance of happening, we pick the one or display it in a way that will make us look less positive to investors. And often this means that when it's an immaterial amount, we don't worry about whether or not we follow the exact accounting rules. For instance, it may be supplies that are going to provide future benefit, but it may be small enough not to matter, and so we are going to go ahead and make that an expense, even though it fits the definition of an asset. The other thing is dividends are never expenses. They do not belong on the income statement. They go on the statement of equity, not, which is what we're going to talk about next. They are shares of the profit. So they have already had the expenses subtracted out. They're what's left after the expenses have been calculated or subtracted. So they themselves are not expenses. So next is the statement of equity or retained earnings. There's your formula right there on the slide. Measures changes in retained earnings. You have a beginning retained earnings, or if you're going to do both retained earnings and capital stock, you'd have two columns. Both of them would have a beginning. You would add in your net income from the income statement. You cannot do your statement of equity or retained earnings until you have net income from the income statement. You're going to subtract out dividends. If you're looking at the column with capital stock, you're going to add any new stock. You should never have a subtraction in that column in Accounting 150, this first class. That's a more complicated scenario for later. And what you end up with is the ending retained earnings, ending capital stock at the end of the year. So again, you have a beginning of the year, an end of the year. If you're reporting financial statements, that beginning and ending should be the same as the income statement, right? Because you're measuring same time period. So the definition of retained earnings is all the income the company's ever made less all the dividends ever paid. If a company's never paid dividends, then it's all of their net income they've made since the beginning of the company, since the business was started. So remember that net income, as long as it's positive, makes them go up. If on the income statement expenses are greater than revenues, then you have negative net income. We refer to that as a net loss. That would make retained earnings go down. Authors seldom put that in textbook, and I don't think ours is going to change that. We're going to have too many of that. It just seems so sad to have that happen, but it is possible. Capital stock is that amount originally invested by the company by shareholders. That's why it doesn't normally go down, because once you've invested it, it's kind of forever. So there's your two pieces of the equity part and the equity statement of equity, retained earnings, capital stock. That's what you're explaining, those two items, which are then going to flow to the balance sheet. And this is in order. You do the income statement, then statement of retained earnings or statement of equity, and then the balance sheet, also referred to as a statement of financial position by fancy folks sometimes. And here we find the accounting equation, which is going to be a crux of an awful lot of what we do for the rest of the term. And that is assets equal liabilities plus equity. That equity can be referred to as shareholders' equity, stockholders' equity, owners' equity, but the generic term is just equity. We, on the balance sheet, separate assets into current and long-term based on when they're going to be used. If they're going to be used in the next year, they're current. If use is going to go beyond 1 year, then they are long-term. Liabilities are also separated into current and long-term based on when they are due, when they're supposed to be paid. If it's due in 1 year, it's a current liability. Due past 1 year, it is long-term liability. So capital stock and retained earnings together equals our equity. So the overall term is equity. Capital stock, retained earnings added together equals that equity. So you could say that assets equal liabilities plus capital stock plus retained earnings. A way of rearranging and think of it another way is net assets equal assets minus liabilities, which is also the same as equity. If you rearrange the accounting equation, assets minus liabilities equals equity. Sometimes that's referred to as net assets. If you're going to change net assets, you must either change capital stock by money from the shareholders. That's the only way to do change capital stock, or retained earnings by increasing or decreasing net income or dividends. And remember, net income is what? Revenues and expenses. Revenues minus expenses, simplified at least. So if you're going to change retained earnings, you've got to change revenues or expenses or dividends. Gains and losses as well, but as from a generic standpoint. So that is how you want to think about the change of things affecting. Each of these financial statements affects the other. You cannot do the balance sheet till you know what your ending retained earnings is, or your ending capital stock is from your statement of equity. So this wonderful accounting equation, it must stay in balance. Any changes to the business must change both sides of the equal sign. If you change an assets, you either have to change another asset. One asset goes up, another asset can go down, and that would keep it in balance. But if this side, one asset changes and goes up or down, then there must be a corresponding change on this side. You can have equity go up and liabilities go down, and that would offset and keep it in balance. The point is, the equal sign there must be kept in balance. That's why it's called the balance sheet. This balance sheet is to measure the assets, the liabilities, equity at a particular point in time on one single day. Typically, the day at the end of the period that you used for your income statement and statement of equity. So there's a beginning balance sheet, what assets, liabilities, and equity was at, say, January 1. Then you have income statement and statement of equity for January 1 through December 31st. And then you have another balance sheet, which is why there's usually two balance sheets given in the financial statements at the end, after all of the things have happened on the income statement and statement of equity. So the balance sheet is like a picture snapshot because it just freezes everything in time for 1 second or 1 moment. And the income statement and statement of equity is like a movie. It explains what happened, how we got from the beginning balance sheet to the ending balance sheet. Statement of cash flows. Our fourth statement measures, and this always is done last, it measures the change in cash from the beginning to the end of the accounting period. So we had $50 in cash at the beginning, we have $200 of cash at the end. How did that change? How did that happen? And it basically classifies all the changes in cash into three areas. Operating activities, anything to do with our day-to-day operation, buying and selling stuff, employees, all that good stuff, goes in operating activities, and we're only looking at those things that affect cash. Then we take plus or minus our investing activities. This is buying or selling long-term assets. And then we plus or minus our cash flows from financing activities, which is borrowing money, paying it back, or money from or to shareholders. From or to shareholders go under financing. If it's going out, we're going to list it on the cash flow as negative cash, or in parentheses, which is the way we do things in accounting, because it's really hard to tell if it's that little minus sign out as a negative is a minus, or if you meant that to be like part of the number that you wrote. And cash coming in is going to be listed positive, usually with nothing around, it's just normal. So if you see a number on the cash flow and it doesn't have parentheses, that means it's cash coming in. If you see parentheses, it's cash going out. And then a diagram as to how these all work together. Start with that beginning balance sheet, like we said, left over from the previous year. Balance sheet is left over, meaning what you had in your assets, liabilities, and equity on December 31st, 2019 is what you start with on January 1st, 2020. That's carried over. Those are referred to as permanent accounts because they carry forward. The income statement then starts on that January 1, revenues less expenses equal net income, which then flows over to the statement of equity, of course, and then has the ending retained earnings and capital stock, which carries over to the balance sheet at the end of the year, of the accounting period. You see the formula there. Then you have, after you've got that all figured out, you can look at the cash beginning, cash at the end, and explain the changes based on either it being operating, investing, or financing. That then equals the cash on the ending balance sheet. So you have cash at the beginning of the year, you have cash at the end, and this is the explanation of how it changed. When you get to the new year, your income statement starts over. You have zero when you get to the end of 2020. You have, and go to 2021. The balance sheet carries over, but the income statement starts over at zero. You have zero revenue now because it's a new year, new accounting period. No expenses yet. They start happening when you start January 1, 2021. Same with the statement of retained earnings. The beginning balance, the ending balance for 2020 becomes the beginning balance of 2021, but you have zero net income, you have zero, not zero retained earnings, but you have zero dividends. Okay, so all of your stuff from the income statement ends up in retained earnings, which is why when you carry over retained earnings on the balance sheet, from one year to the next, it is carried forward, and you can start the income statement over at zero with no revenue, no expenses. So here is the Home Depot balance sheet, you see there's the beginning of the fiscal year, which they start on February 3rd, 2019, and the ending. So this would be where we carried over from the year before, and then we would have the income statement, measure all the things that happened. We would have the statement of equity, which would measure the changes in these numbers down here. Move down to the retained earnings and capital or common stock. Here's what they started with and they ended, no change. So that part of the statement of equity would be pretty boring. But retained earnings changed, and this would show the net income and from the income statement, and the dividends from the statement of equity would be the two changes to retained earnings. You see the total assets equal the total liabilities, and they use the term stockholders' equity. You have the liabilities, you have your assets listed, separated between, as we mentioned, current and long-term. Now, most companies don't call it long-term, they just do all the current, and then you're supposed to know that the rest is non-current or long-term. Same with current liabilities. Most of their liabilities are current, at least as far as the list is concerned. The total dollar amounts is less than the long-term debt, which is at least is labeled as long-term. And we've got the 2 years, so we can see the change. And then, of course, the cash flow is the change in the cash from 1.7 billion up to 2.1 billion. And that is this statement. Cash flows. Here's your operating. They had 13. That's a positive, right? You know that's cash coming in. They had 2.6 billion cash going out to buy long-term assets. That's the investing part, right? It has to do with long-term assets. Then financing, paying and borrowing money and paying it off. They obviously paid a lot more than they borrowed, of 10 billion, almost 11 billion. That's in parentheses, that's negative, that's cash going out from financing. So there's your three sections. We're not going to worry about the detail of those sections at this point, because you need to know it lists those things that change the cash between the beginning and the end of the year. So that's how those financial statements operate, what they look like, and how they work together.